This is the ultimate guide to money market funds. By the end of this video, you'll be an expert on money market funds and will not only be able to evaluate the best money market fund for you, but also will look smart when you can explain all of these concepts to your friends, family, and coworkers. As a quick overview, most money market funds are mutual funds that purchase short-term investment securities like treasury bills to produce a liquid cash-like investment that has a competitive yield. You can sometimes purchase money market funds at a bank, but we'll be focusing on money market mutual funds that you can purchase through a brokerage account, as they are much more widely accessible and transparent about their investments. As you can see, we have a lot to discuss about money market funds, so let's jump right in with probably what is one of the most important aspects, which is yield. Yield is like the annual interest rate for the money market fund, and it is highly dependent on the federal funds rate. Here's a long-term history of the federal funds effective rate going back to 1955, and this is effectively the short-term interest rate set by the Federal Reserve. When you hear the Federal Reserve moving interest rates, this is the rate they're talking about. This rate directly affects the average interest rate that most money market funds are yielding, and most funds will yield pretty close to around the federal funds rate minus the expense ratio of the fund. Zooming in a little bit to more recent history, you can see that the current federal funds rate of 4.83% is the highest that the rate has been since prior to the financial crisis. So it's been almost 15 years, but investors are finally being able to get some interest from money market funds. This is part of the reason why they've exploded in popularity and are becoming a much more valuable tool for investors to manage their portfolios. Most funds will advertise right up front what their yield is. As an example, let's take a look at two money market funds. These money market funds are offered by Vanguard as their federal money market fund, as well as their Treasury money market fund. In this case, there's a lot to cover, but we're going to start first with just the yield. What you want to look for when comparing money market funds is the 7-day SEC yield, which should be pretty clearly stated for most funds. This 7-day SEC yield is effectively the average annualized income or dividend over the past 7 days. So basically over the last week, if this rate of interest continues for the entire year, this is what the fund would pay out. Generally, the higher the yield, the better, but there are some caveats that may affect your decision on which money market mutual fund is best for you. So with the yield covered, the next thing we'll be looking at is the expense ratio of the fund. So Vanguard is quite good when it comes to expense ratios from what I've seen on my own research, and I think they are probably the most competitive in terms of lowest expense ratios when it comes to money market funds. So an expense ratio here for VUSXX is 0.09%. In other words, 9 basis points. So the way to think about expense ratios in the context of money market funds is add up the expense ratio plus the 7-day SEC yield. So in this case, that would be 4.9%. That's basically all the income that the fund or the securities that the fund own is bringing in. Of that 4.9%, 0.09% goes to Vanguard to manage the fund. And then you, on the other hand, get to keep the remaining 4.81%. This is why expense ratio is such a huge factor when it comes to fixed income investments, and that includes money market funds, because since the income is the primary way for you to get return from those fixed income investments, higher expense ratios directly take away from that return without any compensation for lower risk. Another way to put that is if you have two companies offering two money market mutual funds, each of them buying the exact same underlying investments in the fund, but one of them has a higher expense ratio, there's absolutely no reason why you wouldn't want to go with the lower expense ratio. As a general rule, anything above 0.4% or 40 basis points as an expense ratio is a little bit of a red flag. At that point, anything above that is pretty excessive and starts to really take away from the return from the fund. All right, with expense ratio down, we'll next cover the fund type. And this is a little complicated because there's been some money market reform that has changed some of the rules around money market funds, particularly which type of money market fund. So Vanguard has a nice little summary that we'll be using here. And effectively, the three types of money market funds are retail, government, and institutional. Now, for most individual investors like you and me, this means basically money market funds fall into two types: retail and government funds. Government funds effectively invest primarily in government securities, as the name sort of implies, whereas retail money market funds, sometimes called prime money market funds, also can invest in corporate securities like short-term corporate debt to produce a slightly higher yield. Both retail and government funds aim to keep their net asset value stable at $1, so it's effectively like a cash investment. However, with the new regulations, there is now the ability to impose what are called liquidity fees and even temporarily suspend withdrawals, known as gates, in certain circumstances. Those conditions are as follows. A fund may impose a fee of up to 2% on redemptions if a fund's weekly liquid assets fall below 30% of its total assets. So this is jumping ahead a little bit to our discussion on weekly liquid assets, but effectively weekly liquid assets are any of the assets in the fund that can be easily sold within 5 days. What this liquidity fee means in practice is if the fund is relatively illiquid and people start pulling assets out of the money market fund quickly, it might force the fund to sell some of their illiquid assets at fire sale prices, and they want to avoid that as much as possible. So this allows them to sort of slow down those withdrawals by charging a 2% fee if you pull your money out during this period. Now, obviously, as a consumer, this isn't great. We don't want to be hit with fees if we want to have access to our money, especially in a period in time where there's volatility, and that would be probably the period where we most want to have access to our money. Additionally, a fund they have no choice, they must impose a 1% fee on redemptions with the option of going up to 2% if a fund's weekly liquid assets fall below 10% of its total assets, unless the fund's board determines a fee would not be in the best interest of the fund. So this is a little confusing because it says the fund must impose a 1% fee on redemptions in that condition, but it also says, well, they don't actually have to if they decide they don't want to. So it's a bit unclear exactly what would happen in that situation, and it seems like there's a lot of discretion when it comes to the fund's board and to how to approach that situation. Needless to say, if weekly liquid assets fall below 10%, that's a pretty big issue with the fund, as it can become illiquid very quickly, especially if news of that got out and people started pulling money out of the fund. In those extreme scenarios, a fund may impose a gate, that is, suspend redemptions entirely for up to 10 business days in a 90-day period. So what this effectively means is that money market funds may say, hey, sorry, we're not going to allow you to pull your money out of these funds. They can do that for 10 business days in a 90-day period. That could be 10 days in a row, or it could be a day here, a couple days here, another day here, etc. Now, obviously, these are extreme measures, and a fund doesn't want to do this if they don't have to. But as investors, we should be aware of the potential impact these liquidity fees and gates could have in certain situations. Now, the main caveat, which maybe I should have started with, is that these liquidity fees and gates apply only to retail and institutional funds, but with the big asterisk here, government funds may also voluntarily adopt them if they're previously disclosed to investors. And with that respect, Vanguard's been very clear, and this is a solid advertisement for their funds. The board of directors of Vanguard's government funds have decided to impose neither fees nor gates. So basically, if you purchase one of Vanguard's government money market mutual funds, none of these liquidity fees and gates apply. So I know that was a lot on the fund types and money market reform, which probably is pretty boring to most people, but when it comes to periods of extreme market volatility, it is an important risk to consider. Next, we'll talk about fund managers, and this is effectively the companies offering these funds. So as we've mentioned before, Vanguard is one of those companies that does offer money market mutual funds. And here's the relatively short list of the funds they offer. The ones we looked at before were the Federal Money Market Fund and the Treasury Money Market Fund, but they do have a few other municipal money market funds if you live in some high tax states or have a high tax bracket. Other companies like Fidelity offer their own set of money market mutual funds. In this case, the list is much longer, which can be intimidating, but a lot of this is due to different fund classes, which require a certain minimum investment to be able to purchase them. And many of these are likely restricted to institutional investors, unless you've got a casual 1 or 10 million available to put in these funds. Probably one of Vanguard's more comparable money market funds is their government money market fund here, SPAXX, which we can just take a quick look at to compare against Vanguard's Federal Money Market Fund as well. So in this case, they have an SEC yield of 4.73%, which is noticeably lower than the 5.2% offered from Vanguard. And if you were paying attention from earlier, you can probably already guess why this is. And that's because Fidelity charges a much higher expense ratio for this fund. So while I am a fan of Fidelity and their services, their money market offerings simply aren't as competitive as Vanguard, especially for smaller sum balances. Now, if you have access to a lot more capital, you can purchase slightly higher classes of money market funds with Fidelity that will help lower that expense ratio. But that restriction doesn't necessarily apply with Vanguard, as you get their best class of money market funds with a minimum investment of $3,000 for each fund. And I know this starts to sound like an advertisement for Vanguard funds, but really just they have the most competitive. But if you have a Fidelity account, this is still a fairly good yield, even if you do have to pay a higher expense ratio. All right, with that out of the way, I want to go to tax advantages next. So for this, there's an important term, which is US government obligations, sometimes abbreviated USGO. And if you've invested in money market funds during the year, this is something that you may or may not be aware of as a tax benefit to you. But since many of these funds invest a portion or all of their investments in US government obligations, the percentage that are invested in USGOs are exempted from state income tax in the United States. You can find out the percentage of the fund that was invested in US government obligations during that calendar year by simply Googling the fund provider's name, for instance, Vanguard, and then USGO percent. And you should get a link to a page with a PDF that has all their funds and their USGO percents. How this relates to you is we'll actually look through a sample calculation. I think we've got it down here, and I'll zoom in, I'll zoom in a little bit better so you can see. Okay, so here's our tax advantages sample calculation. So we've got the two funds that we looked at before, the Vanguard Federal Money Market Fund and the Treasury Money Market Fund. So these are the before tax yields, so 5.01% and 4.81%. I'm assuming that you have a federal tax rate of 22. This is actually pretty irrelevant for this calculation because you'll be paying the federal tax rate, the full federal tax rate, for both of these funds. So this doesn't really matter. What matters is your state tax rate. So for instance, if you have a state tax rate, and this is your marginal tax rate of 5%, Vanguard's Treasury Money Market Fund has a USGO percent of 100%. So they are fully invested in US Treasuries. Your total tax rate in that case will be 22%, just the federal tax rate, because 100% of this income from this yield is exempt from the state tax rate. So if you do the calculation, your after-tax yield is actually going to be roughly 3.75% after you account for the 22% federal tax rate. For the Vanguard Federal Money Market Fund, despite the name federal, it invests just 30% in US government obligations, which means that 30% of this yield is exempt from state income tax, but you'll still be paying 5% on the other 70% that wasn't invested in USGOs. So this means your total tax rate is a bit higher in this case because you are paying that state income tax, and that reduces your after-tax yield, in this case, to a little bit less than the Treasury money market after-tax yield. So this is something you should consider when picking the best fund for you, especially if you have access to both these funds with a Vanguard account. You should be able to do the calculation for yourself on your own marginal state tax rate to see which one would be a better after-tax yield for you. If you're lucky enough to live in one of the states without an income tax, then the Vanguard Federal Money Market Fund will always have a higher after-tax yield if it has a higher before-tax yield. So that is the tax advantage with money market funds. If you are not aware of the US government obligation percent, make sure you consider that when doing your taxes, or make sure your person who's doing your taxes is aware of that as well. When it comes to investment minimums, we've talked about that a little bit before. When you invest in these funds for the first time, a lot of them will require an initial investment, which means you have to have at least that much or more to purchase that fund. In this case, these Vanguard funds have a $3,000 minimum investment. However, I believe if you open a Vanguard brokerage account, the Vanguard Federal Money Market Fund is automatically set to your settlement fund. So whatever cash that you do put into your account, I believe that is going into the Federal Money Market Fund, even if you aren't quite at that initial investment level yet. That I would say would be an exception for your settlement fund. And as we talked about a little bit with Fidelity, there are some money market funds that have a sort of premium class that require a larger minimum investment. In this case, the Fidelity Money Market Fund Premium class requires $100,000 for the minimum investment. What you get with this is a slightly lower expense ratio, about 10 basis points, compared to the other class of investment funds. So the investment minimums are mostly just a logistical aspect of money market funds, but something to consider. Transaction fees for Vanguard and Fidelity are non-existent. They are no-fee money market funds. However, if you purchase a money market fund outside of Vanguard or Fidelity or through another company, there may be transaction fees, and these are something that you probably want to avoid entirely. So avoid probably purchasing any fund with transaction fees, as these transaction fees are almost effectively like those liquidity fees we talked about earlier, except they apply all the time if you're moving money in or out. And finally, for sort of key return considerations, fund availability is another one that might be disappointing to some folks. So for instance, if you have a Fidelity brokerage account, they will not allow you to purchase a Vanguard money market fund within a Fidelity account. So if you want to have access to Vanguard's sort of premium tier, so to speak, of money market funds, you'll need to have a brokerage account with Vanguard directly. Part of that reason is most brokerages want to keep assets that are within their accounts in their funds, as they make more money that way. So they might limit the availability of competitors' money market funds to avoid investors moving simply to the highest yielding fund. Now, one way you can potentially get around this is to have multiple brokerage accounts. For instance, if you had one with both Fidelity and Vanguard, you'd have relatively wide access to both of their fund portfolios. So just something to keep in mind. So now we can talk a little bit about risk and liquidity. So access and liquidity, these are very important concepts for money market funds because you are effectively investing in a cash-like investment. So you want to have that cash-like liquidity for your assets into your fund. So Fidelity has a nice little summary when it comes to money market funds and their advantages. One of the aspects is liquidity. So in practice, you're able to easily move money in and out if you want to get cash, pay a bill, or make another investment in your account. And Fidelity is actually pretty good about this. If you make a request to move money out of your money market fund and into your checking account, you oftentimes get it back in your bank account the same day. And that's actually one of the fastest when it comes to brokerage accounts and liquidity. I think for Vanguard, when you process a redemption from a money market fund, it takes about 1 to 2 days for it to hit your bank account, which is still not bad, but I've just been very impressed with Fidelity's speed in that process. And another note on the money market funds, which probably could be its own topic, is that these funds aren't insured by the FDIC, but they have an equivalent insurance for brokerage houses. And generally speaking, I'd be willing to go out on a limb and say that the money market funds managed by both Fidelity and Vanguard are probably likely safer and more conservative than many of the investments that are being done in FDIC insured banks. This is currently May 2023 when this is being recorded, and there've already been a significant number of large bank failures this year, probably more to come, all of which were insured under FDIC, but that doesn't protect the bank from going under if they make bad and risky investments. So it's important to keep access and liquidity in mind, especially if you want to use the money market fund for a cash-like alternative for instance, savings or whatnot. Yeah, as a quick note, I have been impressed with Fidelity's speed when it comes to moving money back and forth. We've actually covered liquidity fees and gates pretty in depth earlier, so I think we've covered that. Portfolio assets and composition is something worth taking a look at. So this is Vanguard's Federal Money Market Fund. In this case, you can see that the majority of the assets are repurchase agreements, followed by U.S. government obligations, and then a small amount in U.S. Treasury bills. So the repurchase agreements is something that maybe people aren't exactly clear on what that is, and that has a lot to do with money market funds as they use these repurchase agreements a lot. So effectively what these repurchase agreements are is money market funds have a lot of cash, and there are lots of banks and institutions out there that have certain capital requirements where they need to have certain levels of cash. Seeing this opportunity, money markets can then enter into a repurchase agreement where money market funds will give the bank some cash. In return, they'll get a security they can hold, and then the next day, the bank will buy back that security at a slightly higher price. This can allow money market funds to achieve a yield that's slightly higher than just holding that same security themselves. U.S. government obligations, as we've talked about before, are those assets that are exempt from the state income tax, which also includes treasury bills as well. Generally speaking, the highest quality assets a money market fund can hold are treasury bills, with a close second being repurchase agreements that are backed by treasury bills as well. Government money market funds won't have any corporate securities, but if you have a prime money market fund, it is possible that you have some assets at least invested in those corporate short-term securities. So applying this knowledge of portfolio composition and risk to the two money market funds offered by Vanguard, we can see that the Federal Money Market Fund is likely just marginally riskier than the Vanguard Treasury Money Market Fund, which has all of its assets either in treasury bills, government obligations, or in this case, repurchase agreements backed by Treasury bills. This explains a little bit why the SEC yield for the federal money market fund is a bit higher than that of the Treasury money market fund, as there's just a little bit more risk with the federal money market fund. Daily NAV, or net asset value, is something to keep an eye on, just to make sure there aren't any odd or unexplained variations in NAV when you're looking at your money market fund. So for Vanguard's federal money market fund, we can see the daily market value. This is the NAV right here. And this should be pretty close to almost exactly $1. In this case, it's $1.0001, or $1 plus 1/100th of a penny. And that's fine. Normally you'll see this amount fluctuate by a few hundredths of a penny. And most of the time, it should always be at or above 1. There are some instances where it might drop below 1 by 1, 2, maybe 3/100ths of a penny. And that's still okay depending on the market situation. If there's significant volatility, it's possible that temporarily the asset value of some of the assets might go down just a bit to affect the daily market value. However, if it goes below, I'd say 5/100ths of a penny. So I'm gonna edit this in the website just so you can see what that would potentially look like. So if it gets to something like that, where there's a significant drop in the daily net asset value, that's something that might be a little bit more of a sort of red flag concern. But for the most part, that should be relatively rare. If it is an ongoing concern that it is not going back to that $1 NAV, then that might be a sign to say, hey, maybe I should move over to a money market fund that has that more stable $1, because there aren't any underlying issues there. That might be more overly cautious than you need to be, but when you're talking about money market funds and sort of the risk, or as close to risk-free portion of your portfolio as you're going to get, I personally wouldn't want to take any extra chances if I didn't need to. And as you can see for the Vanguard Treasury Money Market Fund, their NAV has been roughly $1 for the last week or so. And then this is Fidelity's Treasury only money market fund. And in this case, instead of a table, we have a little bit of a graph for the daily market value. So you notice that back in October of 2022, when there was a period of market volatility, we saw that the NAV did actually go below $1 by a few hundredths of a penny. However, since then, it has been at or above that $1 net asset value. So those are all fine and pass the test. What you want to see is make sure it's at or above 1, or if it is below 1, only by a few hundredths of a penny, and ideally only during periods of extended market volatility. Daily liquid assets and weekly liquid assets are two things we can cover together. Going back to the Vanguard Federal Money Market Fund, we can take a look at the daily liquid assets. So these are the assets that can be liquidated within 1 business day, whereas the weekly liquid assets, as we talked about before, will mature within 5 business days, or they become cash in 5 business days. So at this point in May of 2023, the fund has about 60% of its assets as daily liquid assets, or assets that mature within a day, and about 66, or 2/3, as weekly liquid assets. So another way to put this is that if you had an extreme example of where 30% of the fund decided to pull their money out, Vanguard would still be able to cover this, as they have 60% of their assets as daily liquid assets, so they'd be able to redeem that amount the next day. Obviously, that's an extreme example, but it shows the importance of having both daily and weekly liquid assets for periods of volatility if there's significant net outflows of the money market fund. In this case, as you can actually see here in the daily net shareholder cash flow, this is all cash that's coming into the fund. So in the context of May 2023, when we have bank runs and bank crisis and bank volatility, a lot of people are fleeing to money market funds, both for the relative safety of not having to worry about their bank collapsing, but also for the actually very competitive yield that these money market funds are returning. For comparison, if we look at the Vanguard Treasury Money Market Fund, which we said was a slightly lower risk fund and is invested fully in treasuries, you can see that the daily liquid assets 99.5 and the weekly liquid assets are 99.98%. So effectively what this is saying is that if 99% of the entire fund decided to liquidate immediately, Vanguard could cover that entire distribution tomorrow. So this is an exceptionally liquid and safe fund, and this is probably my preferred fund for money market investments, but that would be assuming you do have a state income tax where you can take advantage of the tax or state income tax free nature of the USGO investment percentage and get a higher after-tax yield. Otherwise, the Vanguard Federal Money Market Fund probably looks pretty good for those without that state income tax or a low state income tax. And even if you don't have a state income tax, you can decide for yourself whether or not the benefit of having a fully liquid money market fund compensates you for the slightly lower after-tax yield that you would have gotten if you just invested in the federal money market fund. That's up for you to decide, but the state tax rate does change the after-tax yield as we discussed earlier. So something to consider depending on where you're located in the US. All right, so weekly liquid assets and daily liquid assets we covered. The last thing I want to talk about for money market funds on risk and liquidity is the average maturity and average weighted life. So average maturity, like the name implies, is effectively the average maturity of all the loans, or on average, how long does it take for all the assets to become liquid again as cash? Average weighted life is a variant of this metric, and it's effectively an estimate for when half of the outstanding principal will be repaid. So effectively thinking about all the investments in the money market fund, it's how long until half of that matures and becomes cash. So in this case, for the Vanguard Federal Money Market Fund, it has an average maturity of 12 days and a weighted average life of 48 days. Compare this to the Vanguard Treasury Money Market Fund, where the average maturity is 24 days and the weighted average life is 32 days effectively. Going back to the Federal Money Market Fund, what the difference between the average maturity and weighted average life is saying is that there's a higher variance of maturities within this portfolio. In other words, you have a fair amount of securities that are maturing relatively quickly in under 12 days, but you also have some longer duration securities, which brings out that weighted average life to much higher than the average maturity. Comparing this to the Treasury Money Market Fund, where the weighted average life and average maturity are much closer together, effectively implies that within the portfolio, most of the maturity dates are much more clustered and closer together. From a risk perspective, going back again to the Federal Money Market Fund with a higher weighted average life, there might be slightly more risk here in the sense that you have some slightly longer dated securities that'll take more time to mature and turn into cash. This means that the fund might generally be a little bit more sensitive in terms of that net asset value to changes in interest rate. So if interest rates were to suddenly increase dramatically, given the longer weighted average life of the fund, you might see the net asset value drop more than, let's say, the Treasury Money Market Fund. Generally, 50 days is not that long, so I wouldn't be super concerned about this. For example, if we look at Fidelity's Government Money Market Fund, they have a weighted average maturity of 21 days and a weighted average life of 75 days. So that's a jump from 50 days to 75 days of weighted average life. I generally say that a money market fund with a weighted average life of 90 days or more would potentially be a little bit concerning, because at that point you're pushing out the maturity profile of the fund, so much so that it's debatable whether or not you're now a money market fund or you're starting to try and merge into maybe slightly an ultra short-term bond fund, which does have more underlying portfolio risk compared to a shorter maturity money market fund. That's being a little nuanced here, and these probably aren't something to worry about too much, but it is something to consider. Generally speaking, the lower these days are, the more liquid the fund is. The more liquid the fund is, likely the safer it is. So the average maturity and average weighted life are a few other metrics of risk and liquidity that, when combined with the NAV portfolio assets, as well as the daily and weekly liquid assets, those are all good metrics to help assess the risk and liquidity for the fund. So now we've been through almost all of the aspects of money market funds, so you should have a pretty good understanding already about what to look for in money market funds, what to look for from a benefit perspective, and also what to look for and potentially avoid from a risk and liquidity perspective. So at this point, we can figure out how do you find the best fund for you, and that really comes down to a few factors. One of them obviously is yield. You want to have the highest yield possible for all else equal, the same risk. There's convenience. So if you already have a brokerage account with, let's say, Vanguard, you have access to Vanguard's funds and maybe aren't really as interested in setting up a whole new brokerage to have access to, let's say, Fidelity's fund, and vice versa there as well. And then the final consideration is liquidity risk. If you have serious concerns about, let's say, the banking sector and or potential flows from money market funds for whatever reason, or you have serious concerns about liquidity fees and gates being imposed on money market fund outflows, then risk and liquidity concerns likely should take a top spot in considerations when picking your fund. That being said, after evaluating all the fund options across both Fidelity and Vanguard, sort of two of the biggest brokerage houses there are, I think if you have a Vanguard account or are willing to create a Vanguard account, picking between the Vanguard Federal Money Market Fund as well as the Vanguard Treasury Money Market Fund are likely two of your best options. Reasons for this is it has the most competitive yield, primarily as a function of having the lowest expense ratio. If liquidity and risk is a concern, then the Vanguard Treasury Money Market Fund is likely both the safest and most liquid fund when it comes to underlying portfolio assets. You do have a slightly lower 7-day SEC yield compared to the Vanguard Federal Money Market Fund. However, as we discussed, there are some state tax benefits if you live in a state with income tax, where your after-tax yield might actually be higher given the benefit of 100% investment in US government obligations, which are exempt from state income tax. Now, let's say you're in the position where you don't have an account with Vanguard, but you don't really want to go through the hassle of creating an account, then you'll have to reassess using the tools that we've gone through over here, how to find the best fund for you that is available within your brokerage and the options they provide. For those who have an account with Fidelity and are not interested in creating a Vanguard account, the decision on which money market mutual fund to pick is a little bit more complicated, as there are 31 options to choose from, as opposed to the 6 or 7 at Vanguard. But I'll leave it as an exercise for the investor to apply the tools that we've gone through, and you should be able to narrow it down likely to 2 or 3 money market mutual funds that look competitive as potential options for the best fund for you. So you have the tools to find the best fund for you, though I would probably assume for most people, it likely is going to be one of the Vanguard fund options, either the two that we've mostly been discussing, or I believe you also have the Vanguard Cash Reserves Federal Money Market Fund. So overall, you now have the tools to find the best fund for you, although I'm assuming for the majority of people, it likely will be one of the Vanguard fund offerings that they have for money market funds. But that again depends on the convenience, if you already have a Vanguard account and are willing to create one versus not. And finally, we can quickly discuss some of the best uses of money market funds. At this point, their advantages are likely pretty clear. They offer a very competitive yield with cash-like liquidity. So these can be quite good for emergency savings accounts. Also, they can be used as a regular savings account in a sense, and savings for specific events. So let's say you're saving up a down payment for a house. It's likely going to be more beneficial to you long-term to save that in a higher yielding money market fund than it is to have that, let's say, in a checking account at a bank where it isn't earning any interest at all. Another use of money market funds that is quite useful is as sort of we say in the investment community, dry powder to deploy for future investments. And dry powder being effectively just liquid cash-like investments. In other words, money market funds that can be used to purchase securities during periods of market volatility where it might be opportunistic to buy. I personally keep a portion of my money market funds specifically earmarked for this purpose, as it's a way for that capital to earn a low risk rate of return while I wait for more attractive investment opportunities. And finally, a third option for using money market funds is as a bond replacement. So many investors have bonds as a component of their portfolio, and this works to provide interest or dividends from fixed income or bond investments. Now, typically those investments have much longer duration, so you're locking in your capital for 2, 5, sometimes even 10, 20, or 30 years. Under normal economic scenarios, usually locking up your capital for a longer period of time has more risk, and so you should be compensated for that with a higher interest rate. However, in this odd period in time, at least in May 2023, we have an inverted yield curve where you're actually paid more to take on less duration risk, where you get rewarded with a higher interest rate investing in money market funds than you do from equivalent long-term bonds. When looking at the US Treasury yield curve, we can see that those investing in 3-month Treasury bills are earning an interest rate of 5.25%, whereas someone who decided to lock up their capital for 10 years would be earning almost 2% less interest over that entire time period at an effective interest rate of just 3.46%. Now, obviously, with these lower interest rates, there's expectations that these short-term rates will eventually come down to much lower than the current 10-year yield. However, for the time being, investing in shorter-term duration securities provides a much more competitive yield than longer duration ones. If you are worried about interest rates staying high for longer, or even interest rates rising further, then shifting a portion of your bond component of your portfolio to money markets instead could be a way to both get a higher yield on your capital returns, as well as lower the overall duration and interest rate risk of your now bond and money market component of your portfolio. Whether or not you use money market funds as a full bond replacement is up to you. Personally, for my portfolio at this point in time, I've decided to use it as a complete replacement, so I own no bonds in my portfolio. Instead, use money market funds, which offer a higher yield and less risk as that component of my portfolio for now. So personally, I use money market funds for all 3 of these purposes, which you might be able to as well, but you don't necessarily have to and might find more value in using money market funds for one specific purpose or a couple of these. Either way, you now have the tools to best assess which fund is best for you, as well as the best uses of that fund for you and your portfolio. So hopefully you got some great value out of this Ultimate Money Markets Funds guide, and now are going to look extremely knowledgeable in front of your friends and family. Feel free to subscribe to the channel if you'd like more content like this, and thank you for watching.